Usually when I check the terminal in the morning, I have a pretty good idea what's driving the red or the green.
Right.
A CPI print came in hot, or maybe a tech giant missed earnings. You adjust your hedges, you grab a coffee, and you move on. But today...
Hey, today was different.
Today I looked at the screen, and I honestly thought the data feed was broken.
It's not broken, unfortunately. It's just ugly.
Ugly is putting it mildly. It is Tuesday, January 20th, 2026, and if you're listening to this, you've probably seen the headlines. Stocks are getting hammered, the bond market is selling off, and Forex is.
It's acting like it's 2008 all over again.
Exactly.
Yeah.
Traders are calling it a triple kill.
Which is rare. I mean, usually you get a flight to safety, stocks crash, so everyone buys bonds.
Not today.
Today, everyone is selling everything. But what's fascinating isn't just that the markets are down, it's the why.
But that's where it gets weird. I mean, a global meltdown of this magnitude usually needs a global catastrophe, a pandemic, a massive bank failure.
A hot war involving a superpower, something huge.
Right. But today, we are watching the global financial system buckle because of two things that sound like they were pulled out of a hat.
It really does.
On one side, we have a diplomatic standoff over the United States trying to buy Greenland again. And on the other, a domestic tax squabble in Tokyo.
It sounds almost farcical when you pair them up like that. But this is the classic perfect storm scenario.
That is so.
You have a geopolitical shock in the Atlantic colliding with a liquidity shock in the Pacific, and sitting right in the middle is the U.S. market, which just realized it has nowhere to hide.
So that's the mission for this deep dive. We need to parse how an icy island and a Japanese tax cut managed to send gold to, what is it printing at right now?
Last check, $4,700 an ounce.
$4,700.
Yeah.
Unbelievable. We're going to connect these dots. And more importantly, we're going to talk about the death of the taco trade.
Ah, the taco trade. The thesis that has made everyone look like a genius for the last 12 months.
Until this morning. But let's hold on that for a second, because I want to start with the hard news coming out of Brussels.
Right.
This isn't just rhetoric anymore. The European Parliament has officially frozen the approval process for the U.S.-EU trade agreement.
Which, you have to remember, this was a done deal. This was the July 2025 agreement. It was signed, sealed, and just waiting for the rubber stamp.
So for Brussels to freeze it now is a huge diplomatic signal.
It's effectively saying, we aren't doing business as usual.
And the catalyst, of course, is the Greenland ultimatum. Now, for the listener who thinks, wait, didn't we do this in 2019? Yes, we did.
But this time is different.
Very different. The president took to social media last Saturday with a very specific, very hard deadline.
It's the specificity that spooked the algorithms. He didn't just say it would be nice to own Greenland. He announced that starting February 1st.
Which is practically next week.
Exactly.
Yeah.
The U.S. is slapping 10% tariffs on 8 specific European nations unless talks begin.
And he named names. Denmark, obviously. But also Norway, Sweden, France, Germany, the UK, the Netherlands, and Finland.
It's a maximum pressure campaign. And he escalated it further. He said if there isn't a deal for the comprehensive, thorough purchase of the island by June 1st, those tariffs jump to 25%.
Well, it's the sheer transactionality of it that's jarring. Sell me the island or I tax your cars. But there was another detail in the sources, the late-night map, that I think really shifted the sentiment in Europe.
Well, you saw that.
From annoyance to alarm.
Yeah.
Hard to miss. Alongside the threats, a map was posted, allegedly from the White House, showing Greenland, Canada, and Venezuela all shaded as United States territory.
And crucially, the administration hasn't walked it back. In diplomatic circles, silence is confirmation. The EU isn't viewing this as a negotiating tactic anymore.
They're viewing it as aggressive expansionism.
That's the word. And that's why you saw U.S. Trade Representative Greer come war today. He didn't try to soften the blow. He doubled down. He called the tariff threats appropriate.
So Denmark is in the crosshairs. Prime Minister Frederiksen was pretty blunt in her response. She didn't just say no.
No, she said Greenland belongs to its people and explicitly stated they are preparing for a trade war.
That phrase, preparing for a trade war, that's what triggered the freeze in Brussels.
But here's where it gets interesting for the market. Usually the EU response to this kind of thing is slow. They form a committee, they draft a letter.
This time, they went straight to the heavy artillery. You're talking about the economic weaponry mentioned in our source stack.
Correct. They aren't just freezing a deal, they are preparing a counterstrike package.
Yeah.
We're looking at a retaliatory package targeting 93 billion euros of U.S. goods.
93 billion.
And look at the target list. It's calculated. They're going after Boeing aircraft, U.S.-made automobiles and bourbon whiskey.
The classics. Hit the manufacturing base and hit the Kentucky distillers to pressure the Senate minority leader. It's standard trade war playbook.
But there's something new in the EU's arsenal this time. The ACI.
The Anti-Coercion Instrument. I've seen this mentioned in policy papers, but we've never seen it in the wild, right?
Never. This is something the EU developed specifically because they felt they were getting bullied by superpowers, historically China, but now the U.S. The ACI is the nuclear option.
It goes way beyond tariffs.
Oh, yeah.
So what does that actually look like for a U.S. company? Is it just higher taxes?
It's access. Under the ACI, Brussels can restrict American investment in Europe. They can impose discriminatory taxes on U.S. tech giants operating in the EU.
Okay.
But the kicker, they can ban U.S. companies from bidding on public contracts in Europe.
That's massive. So if you're a U.S. defense contractor or a tech firm bidding on European cloud infrastructure, you're suddenly locked out of the market entirely.
Correct. And that is a revenue hit that Wall Street has not priced in. Yeah. We're not talking about a 10% surcharge on cheese. We're talking about market exclusion.
And the clock is ticking.
The automatic trigger for retaliation is February 6th.
So we have a 2-week window before the Atlantic trade relationship essentially catches fire.
Yeah.
That explains the equity sell-off. I get it.
Yeah.
I'm a trader. I'm dumping Boeing. I'm dumping big tech. But what explains the bond market?
Right.
Stocks going down is one thing. The U.S. Treasury market melting down at the same time is usually a contradiction.
Usually, yes. Flight to safety. When stocks crash, you buy bonds, but not today. And that brings us to the Japanese jitters.
The Six Sigma event. Treasury Secretary Besson's words, not mine.
But he's not wrong. To understand this, you have to understand the symbiotic relationship between the U.S. and Japan. Japan is the largest holder of U.S. debt. They're our banker.
Right.
And for decades, Japan has been the land of zero or negative interest rates. This created the carry trade.
Okay, let's unpack the carry trade, because I think people hear it and their eyes glaze over, but it's arguably the engine of global liquidity.
It is.
So how does the leverage actually work here?
It's simple in theory, dangerous in practice. So you're a global hedge fund. You can borrow money in Japanese yen for basically zero cost.
Because their rates are on the floor.
Exactly. You take that yen, convert it to U.S. dollars, and you buy a U.S. Treasury bond paying, say, 4.5%.
So you're just pocketing the spread. You're making 4.5% on money that costs you nothing to borrow.
Exactly. But you don't just do it with your own money. You leverage it. You do it 10, 20 times over. It's free money. As long as the yen stays weak and Japanese interest rates stay low.
And that as long as just expired.
It exploded. This morning, Japanese 30-year and 40-year government bond yields spiked by over 25 basis points in a single session.
Now, for a novice, 25 basis points, 0.25% sounds tiny. Why is that a disaster?
In the bond world, especially the Japanese bond world, which is usually comatose, that is a tsunami. It's a statistically impossible move if the market were functioning normally. What it means is that the cost of borrowing that yen just skyrocketed.
So the math on the carry trade breaks.
Instantly. If you're that hedge fund, suddenly your free loan is getting expensive. And worse, because yields are up, the yen is strengthening against the dollar, so you're losing money on the rate and you're losing money on the currency conversion.
You get a margin call.
You get a margin call. And to meet it, you have to sell assets. And what's the most liquid asset you hold?
The U.S. Treasury bond you just bought.
Precisely. That's why U.S. bonds are crashing. It's a forced liquidation event coming from Tokyo.
I saw a quote from a Singaporean fund manager in the notes who basically admitted it.
Oh, yeah. He said, the market was so unbalanced, I couldn't help but sell U.S. treasuries to buy Japanese government bonds. He's flipping the flow.
Okay, so why did Japan break? They've controlled their yield curve with an iron fist for years. What changed on a Tuesday in January?
Domestic politics. Prime Minister Sanae Takaichi. She's facing an election, her poll numbers are soft, and she pulled a page out of the populist playbook.
It was.
She proposed suspending consumption taxes on food and beverages.
A tax cut for the people.
A massive tax cut.
Right.
5 trillion yen. That's about $31 billion.
And let me guess, she didn't say she'd pay for it.
Not a word. And this is where the Truss moment comparison comes in. Remember Liz Truss in the UK?
2022. She announced unfunded tax cuts, and the British bond market, the gilts revolted. Yeah. She lasted, what, 49 days?
49 days. Japan is having its Truss moment. The bond vigilantes looked at Takaichi's plan, saw unfunded fiscal stimulus in a country that already has massive debt, and they said, no thanks.
They sold
Japanese bonds, driving up yields, and here we are.
It's amazing how fast fiscal discipline became the narrative again. For a few years there, it felt like deficits didn't matter.
They don't matter until they suddenly do. And when the bond market decides they matter immediately and violently. You have the U.S. Treasury Secretary blaming Japan for the spillover, calling it irresponsible.
And Japan's finance minister is doing damage control.
Katayama, yeah. She's frantically trying to put out the fire, promising they'll cut spending to fund the tax cuts, but the market isn't buying it.
Credibility is a fragile thing.
Once you signal that you're willing to blow a hole in the budget for votes, it takes a long time to earn that trust back.
So let's synthesize this. We have a trade war looming with Europe over a map of Greenland. We have a liquidity crisis coming from Japan because of an election ploy. And the result is the S&P 500 down 2% and the VIX spiking.
Right. But this also signifies something bigger.
The death of the taco trade.
I think that is the most important takeaway for anyone managing money right now.
Let's define it. TACO. Trump always chickens out.
It's blunt and maybe a bit cynical, but it has been the operating manual for Wall Street. The thesis was simple. The president talks a big game. He threatens NATO. He threatens tariffs. He threatens to buy countries.
But ultimately, the belief was that he views the stock market as his personal scorecard.
Exactly. If the S&P goes up, he's winning. If it goes down, he's losing. So investors assumed that if push came to shove, he would always back down from a real crisis to save the market.
They priced in the bluff. They assumed the Greenland thing was just noise, just leverage for a better deal on something else.
But Tuesday broke the thesis. It shattered it. Because look at the timing. The market started sliding, and instead of tweeting, "Just kidding, Europe is great," his trade representative came out and said, "The tariffs are appropriate."
In blink.
He didn't blink. And because Japan had removed the liquidity safety net, the market realized it was falling without a parachute. That realization that geopolitical goals like territorial expansion might actually be more important to the White House than the daily closing price of Apple.
That completely changes how you price risk.
It's a paradigm shift. If the Fed put is gone because of inflation, and now the White House put is gone because of Greenland, you're on your own.
And that's why gold is at $4,700.
You got it. Gold is the asset you buy when you don't trust the government's money and you don't trust the government's policy. It's the ultimate no confidence vote.
It really feels like the feedback loops are tightening. There was one specific story in the research that I thought perfectly captured the irony of this whole situation. The Danish pension fund.
Oh, academic or pension. Yes.
This is a pension fund for Danish academics. Very conservative money. And they announced they're liquidating their U.S. Treasury holdings. We're talking about $100 million.
Right. And listen to their reasoning. They aren't selling because they need cash. They are selling because they view the U.S. as having significant credit risk and unsustainable finances under the current administration.
Think about that feedback loop. The U.S. president threatens Denmark with tariffs to force them to sell their land. In response, a Danish pension fund dumps U.S. debt, driving up U.S. borrowing costs and hurting the U.S. economy.
It's a geopolitical boomerang. It really highlights how interconnected everything is. You can't just bully a country in 2026 without the bond market having a say in the matter.
The bond vigilantes are back.
They are, and they don't care about the map on your Twitter feed. They care about credit risk.
So where does this leave us? We are recording this on January 20th. The first tariff deadline is February 1st. That is a very tight window.
It's a terrifyingly tight window. We are in a fragile standoff. On one hand, you have the EU preparing retaliation that triggers automatically on February 6th.
On the other, you have Japan trying to stabilize a bond market that is shaking the foundations of global finance.
And in the middle, you have a White House that seems determined to pursue this Greenland acquisition at almost any cost.
And the taco safety net is gone.
That's the key takeaway for the listener. For the last year, you could invest assuming that cooler heads would prevail because the stock market was king. Now, we have entered a period where political goals might actually take precedence over your 401k performance.
The era of low volatility might be over.
I think it is. If you're listening to this, you need to understand that the buy the dip mentality works when the fundamental system is stable.
But when the system itself is being rocked by trade wars with allies and credit crises with major creditors,
buying the dip becomes a much riskier proposition.
It's a sobering thought. We've gone from a world where we worried about inflation numbers to a world where we're worrying about whether we're going to trade bourbon for an island.
And if the answer is no, the cost is going to be paid by everyone holding assets.
So here is the provocative thought I want to leave you with today. We spend all day trying to value companies based on cash flow innovation, market share.
Yeah.
But if the taco trade is truly dead, if the markets can no longer count on the president to prioritize stock prices over geopolitical land grabs, how do you price any asset tomorrow? The risk premium just went through the roof. And more importantly, does anyone actually know how much Greenland costs?
Yeah.
Because right now, the down payment seems to be the global economy.
It's a very expensive island.
Indeed. Thanks for listening to The Deep Dive. Keep your eyes on the headlines and maybe check your portfolio. Gently, we'll catch you next time.